Good, I can see. Hello.
Apa kabar?
Back onto the show, Head of Treasury Management at Fullerton Fund Management. Let's invite Darren Tay. Hi, Darren. Welcome back.
Thank you. Good afternoon, ladies and gentlemen. Good to be back. Warm welcome to everyone out here. And Olivia, thanks for having me. And great to be back. And we're going to sort of have more chats about the interest rate and the markets from here.
Absolutely. I mean, we've done several shows together. Now, Darren, we have also pictured a sort of narrative, right, in the past few years. If we're looking at every show as a check-in for the current market.
Mm,
And also, we have so many audience members out there who follow you quite closely and leave a lot of comments
thank
down
you.
below. Now, if they do have questions right now, if you're listening at the moment, you can already start typing in your questions for Darren right here. But Darren, for those who do not know you, give us an introduction about yourself.
Right. So basically, Darren, I run the treasury management at Fullerton Fund Management. So in terms of my core areas, so I manage all the money market portfolios on cash and liquidity funds out here. I look at the so-called trading products for the companies, and I look at the cash flow. So lots of things to be doing day in, day out, and sometimes, of course, Saturday or so. Then I need to work quite hard.
Yes, of course. And we definitely really value your insights and especially those tuning in just about now. We already got some questions coming in about Fullerton and also the current market outlook. So, Darren, maybe you can just begin with the topic of
Mm,
today, right? Just setting a context for us. We're in a new season. We're really emerging into it, right? As we mentioned, and also perhaps give us an overview of the current interest rate cycle.
right. Yeah, no, thanks for that, Olivia. I guess the topic today is about emergence of a new season in the current interest rate environment. I think there are some keywords that we want to be very specific on. Emergence is a change, it's a paradigm shift that's coming through. Season because, wow, the interest rate has been like going from zero all the way to like 5, 4, 6%, and it's peaking, and you saw some rate cuts. What do we do from here? What are the pain points out there? What are the challenges? How do we navigate? And I use the word season because in the past, we always talk about storms, financial challenges that's going through. Where are they now? I think this season's also evolved to new opportunities for all of us in investment, in trading. So I think that'll be interesting. And on a very broad level, in terms of topics which I would like to cover today is looking at, say, for example, the last 27, 28 months of journey that we chat together. I think that'll be very important. And I have some thoughts about what has happened in the last 6 to 9 months, where we are today, how we're going forward in terms of our trading and investment strategy. So these are the high-level views which I thought would be interesting. So maybe, Oliver, with that, let's dive in and I'll just talk about our 27 months journey. How about that?
Absolutely. I think we definitely have
Mm,
questions already
mm,
talking about Fullerton and your journey. Now, maybe you can just explore that a little bit more before
mm.
I go into the next question I have for you.
Okay, sure. So maybe just on the 27 months journey, and I think there's a slide on that. Yeah, there's a run. So the beauty about this whole moomoosg fans out here and all of us is that we have gone through this journey in the last 27, to about coming to 30 months already. And we exchanged views about interest rate environment. And what I would like to share in this screenshot in front of you is that we've gone through a lot of key milestones, and let's just focus on those purple circles at the bottom of the screen. And this basically is a slide about the so-called Fed rate hike cycle. On the first circle that you noticed, that was the first US Fed hike cycle, which started in March 2022. We came out, we spoke about it, we talked about the riding tides out there in terms of a rising interest rate environment. And next, guess what? When you go to about June, July 22, we noticed that inflation was really very high, about 9%. And we came out and exchanged thoughts, exchanged view, and we said we're riding into the epicenter of it. And that was our second presentation. Next, global banking turmoil sort of creeps in March 2023. We all knew that happened. It was really very uncomfortable for a lot of people, all of us. And we said, look, we have to basically navigate the eye of the storm. I think that's very important where we need to go through. And of course, after the banking crisis, the rates did not stop. It went even higher. I said, wow, I think the Fed really thinks they know what is happening out there or they know what to do. And that's why we embrace the storm. That's where we were in November 23 last year. And of course, in today's context, we are starting to see a little bit of turning of interest rate going down. For example, ECB this month did a cut in June 24. So the narrative that we have is it's the emergence of a new season. Okay, those rates going up seems to be very consensus in the last, 20, 30 months. But now we're starting to see a bit of plateauing, a bit of coming down, but not everyone. And we'll just dive into some of this conversation in a moment. So in all, what I'd like to summarize is that it was a long journey. We all came together for the last 27 months, had fun about it, think of it as a strategy, what we need to do, and go from there, right? All of it.
Right. Of course. And thank you for outlining what I was mentioning before, the narrative within not just with
Mm,
our interaction with the audience, but as a whole, right? Talking about the markets in general, and also how we picked off from where we left off in the past live
mm,
show. Yeah. So, Darren, I think you could perhaps expand a little bit more on the current
okay.
outlook that, Fullerton Fund Management sees in terms of insights, and of course, Darren, from your perspective as well, talking about head of treasury management, we've seen a lot, right, within our active investors. And yeah, we will answer some of those burning questions at the end. Keep them coming. But yes, what is your perspective so far on a global scale, if we want to start off with
Yeah,
that topic?
okay, sure. Yeah, maybe I'll just go to the outlook and dive straight in. I guess it's on slide 9, if I may, please.
Mhm.
And if you go to slide 9, and what happened is that if you go the way down, okay, just a moment. Okay, yep, that's the right one. Thank you. So the beauty about this slide is it's not new. It's something that we all shared exchange views in November 2023. Kindly allow me to just focus on the 4 red oval circle. We spoke about the US banking turmoil, the debt ceiling, the Chinese debt property issues, Israel Hamas. That was in November 23. Let's take a snapshot and make an assessment today. Where are we on all these things? And in a very high helicopter view, I'll just highlight a few key points for everyone, if I may. US banking turmoil. I think the beauty is that it was very rough in March 2023 last year. But in today's context, in US, you still have about maybe 4,000, 4,500 banks. It's still a very big giant and financial sector that we're all focusing on. Regulators are putting a lot of pressure to ensure that the big banks, they continue to be able to safeguard the risks and the so-called dynamics of their BAUs. And for the smaller banks, for example, if you look at early part of this year, New York Community Bank, US Bancorp, all these smaller banks feeling some strain. They're cutting their cash dividends. They're also starting to recapitalize their entire so-called stock. So these are also giving us signaling risk and also perspective that it is getting a lot more tighter, a lot more scrutiny that's ongoing. It's not entirely over, but definitely the scrutiny is getting better and better out there. US debt ceiling, this is something very interesting. I would say that US debt ceiling, it looks like everything is calm and peaceful in today's context, but more importantly, the debt ceiling is feeling some pressure. Why I say that is because now it's in a suspension mode. Only in January 2025, what we're going to see is that the debt ceiling conversation is going to come out again. So currently it's in a suspension mode. And why is it so concerning is because in today's context, the Congressional Budget Office, they just came out with some of this observations and a projection. For the year ending September 24 this year, the belief is that the deficit of the US economy is going to be about -6, -7%, which I thought is quite an alarming number. And if this number continue to grow in terms of deficit, what's going to happen is that the rating agencies like the S&P 500, the Fitch, I think did it last year in August, they may potentially downgrade the so-called the sovereign's ratings of US. Currently, it's like AA plus. If that goes on further, there are some pressure that's coming through. And sometimes maybe we ask ourselves, why all this is happening? Well, interest rate debt is growing. We are also trying to retire some of the student loans. We also have more war that you need to fund for the US markets out there, in Israel, in Ukraine. So all these are putting pressure in terms of the budget. And just quickly on the last two US debt markets, the China debt markets out there, it is definitely a little bit more basing, a little bit more stabilized. Price is still a little bit of a decline trend in the property market. But the great news out there is that the government is putting a lot of so-called stimulus out there, improving on home loan buyers, trying to increase and inject, I think, 42, 43 billion into the so-called local government so that they can buy up some of the properties to support them. So these are great. And of course, the last one, Israel and Hamas. The key thing is that it is still ongoing. US, Qatar coming out trying to be the big brothers, which they should, to highlight and say, look, let's have a peace treaty. But I would say that in today's situation, Israel seems a bit more adamant in trying to hang on. Hamas maybe is a little bit more softer in terms of approach. We're not here to debate who's right or wrong, but more importantly, to highlight the fact that there are potentially some of these risks that's still lurking around. To sum up, yes, I think these are challenges. The event risk will continue to evolve, but I guess it's a little bit more contained and probably a bit more into solution based. So that's a high level drift of what happened in the last 6 to 9 months. And yeah, that's where we are. Olivia, maybe what we should do is let's dive in and share a bit more about the interest rate environment globally. I'm sure the crowd would like to hear a little bit more on that.
For sure, for sure. So I think before we go into the emergence of that new season, right? And thank you for highlighting the context of now before we transition in. I do want to just quickly touch on what the current, or at least check in on the current rates decisions, particularly for the US, Europe, and Asia Pacific regions. Just very quickly, could you just summarize for us the insights related to that?
Okay, sure. And in terms of the US markets, currently is still in a deliberation, trying to ensure that it doesn't really sort of like the need for a massive cut in terms of 2024. In EU, you can see that it's starting to really exercise its first cut. And of course, the third one you probably notice is that in Asia, it seems to be going all over the shop. But maybe what I should do is let's just anchor in on, I believe it's slide 10, if I may. It's about some of the high-level drift of where the so-called situation is. If you can, please, for the team out there. So as we wait for the slide, so in terms of these slides out there that you probably notice, thank you. There are also so-called environment whereby the central bank are trying to figure out what do they do from here. And what I mean by this is that there are some who are hiking and some who are cutting and some are just a bit more nonchalant, doing nothing out here. I'll give you a few examples. For example, in Taiwan, they're continuing to increase the interest rate. And why I say that is because they are worried that there's a new dynamics of the asset prices that's coming through. Therefore, they're putting pressure to really sort of like up rates from here. Of course, as you go a little bit deeper, you'll see countries like, say, Indonesia, they're hiking rate because there is a pressure with regard to the currencies. Also, likewise, maybe in some of these markets out there, not just maybe the next one I should highlight is that Nigeria. Nigeria is also trying to so-called increase its interest rate because there's also some preemptive effort that's going through. So these are things that we should be mindful. There are some markets who are also starting to cut. For example, Canada, I think they did their first cut early part of this month, and they felt that inflation is getting to be a little bit more contained. But Olivia, guess what? The inflation is creeping up again from 2.6, it went to 2.9% in the last couple of, in one of the recent so-called snapshot. The pressure is there, and that means that it is very, very difficult for them to continue to cut rates from here. Switzerland, they started to cut rates also. But the beauty is that when they cut rates because the currency is too strong, and that's by default because in the European markets, there are some concerns on the French banks, French markets out there, and therefore there are some of this shift towards the Swiss, the CHF. So this is what's happening. And at the bottom slide out here, as you can see on the screen, is that where are the so-called central bankers, the G10, the major players? They believe that and they are confident that they are able to really win the war of inflation. I think that's what's happening currently. But the crux out there is that it's not certain. They're definitely very careful about trying to do all this arrangement. And I guess as it continues to go, we do see one very interesting trend. It's called the uneven normalization. And what we mean by uneven normalization is that some prefers to cut, some prefers to hike, maybe like Japan is hiking. So that's what I call the uneven normalization. When that happens, guess what? The currency will be impacted, inflation pressure will come, and that creates a different kind of conversation. Maybe that's the reason why Japanese yen is really so weak. They are not happy to really sort of up the rates up there. And yeah, we should be going to Japan very soon for holiday, Olivia. I've not done my Japan holiday yet, but I look forward to doing that soon.
Yes,
I'll talk a bit more in a
absolutely.
moment. Yeah, if I can just wrap up the next two slides in a very quick way. I think the next slide is about the US versus the European market. Just a bit of helicopter view on where this are. Yeah, thank you. That's the right one. On the left-hand side is the US market, the US rate. Right-hand side, the EU. Allow me to share the keyword about the new paradigm, the new season. These three words: validation, value, and velocity. And this is a very important point. I'll touch that in a moment at the bottom of it. But let's look at the left-hand side. I think the question on the US Federal Reserve, they are in this question called, when should we cut rate? Anybody's guess. Your guess is as good as mine, Olivia, and the crowd. We could be smarter than the Federal Reserve, but but the belief is the question mark is when. All right. So I think that's been a key pivotal point. The so-called hike has been enormous. If you look at the left-hand side, it went from March 22, it went for more than 525 basis point, very fast velocity. The key point to share is that the Federal Reserve is still in what I call a deliberation mode. And why I say deliberation is because they look at the data point and the belief is that it doesn't seem that I need to do any rate cut in today's context. That is the key thing that's on their head. And why that's the case is because the view is starting to be a bit more hawkish. If you even look at a few 2-3 weeks ago, they have this thing called a dot plot, which is like every quarter. The belief is that this year, they felt that there's going to be only one cut. If you ask them this question about 3 months ago, they believe there's going to be like 2 or even 3 cuts. So what I'm trying to highlight is that the shift of the dynamics, the so-called paradigm and the seasons and the so-called data point is telling us that the cut is not going to be so aggressive this year. Right-hand side, right high level, the question is not about when to the ECB, is about how many cuts this year and how fast you want to cut it. This is an important point because they have started to cut on the 6th of June for the first time after holding at 4% for about 9 months. And trust me, they didn't just surprise all of us. They already said that they're going to cut since March 2024. They gave us 3 months reaction time. Isn't that the beauty of it? I mean, it's like we all go out there and say, there are some of this point whereby it's not overnight, I'm going to surprise you. I'm just going to do the cut. And I alert everyone 3 months ago. With just a backdrop, let's go to point C, which is at the bottom of it. And this is an important point for takeaway today, is that we should look at the triple Vs. And these three Vs, I sort of form my own concoction, if I may put it this way. The first thing is we should validate the date. When do we think the timing of the cut is going to come? You can look at all kinds of data points, all kinds of what some of the Fed fund futures are. But the more important part, always focus on what the Federal Reserve says. I do track them very closely. I look at their views. I look at the keywords that they use. They will give you very good signaling risk when you should be doing the cut or doing the hike, if any. Second one, the value of it. The value, what I mean by this is we look at the numeracies, the magnitude of the cut. Why that's important is because gone are the days whereby if you look at the last 1-2 years, the hike is like 50, 75 basis point. We call it the jumbo hike, the jumbo. This time around, the value change, if you look at some of this reduction in the interest rate, it will be in 25 basis point. It won't be 50, it won't be 75. So the value is an important point. Watch out for that. That's very important. Lastly, and just to wrap up on this slide, velocity of the move. It's a very important point because on the way up, you can see the desperation out there in the interest rate hike cycle on the way up. Massive, every single meeting, you do something. But when you look at it in today's context, I'm not so sure they're going to do it every single meeting and just keep cutting because that's a bit too inflationary. The more you try to cut, the more you're telling people, I am a bit nervous. And it's going to create inflationary spiral out there. So that will not happen. And if I can just go to the last slide, if I may, just on the outlook. So we keep it very compressed, very so-called compact. We know exactly what's going in the whole world. Let's come to Asia. That's where we belong to a larger extent here. I think the drift is that in Asia Pac, there are some who are still easing, some who are deliberating, some are peaking. We'll chat more of this in the fireside chat later on if we need to. But just on a very high level, look at the top left-hand side for China. They're having so much huge easing in the interest rate since COVID and all the way to even this year, February. Required reserve ratio, the 7 days repos, the loan prime rate, the midterm lending facilities, they have been doing so much cut out there. They are trying to kickstart the economy. I think they're doing as much as they could. I think that at this pivotal point, they just cannot just keep cutting further and further, because by doing that, your Chinese yuan is going to have a different impact. So very bright individuals, bright central bankers out there, you can't just keep cutting every single time. It will create a different kind of signaling rates to all of us. So I think they're thinking very hard what to do next. Right-hand side, Japan, the land of a rising sun. Of course, also the land of rising wages is coming through quite fast in Japan. We're at this stage whereby we're moving away from the 0% price growth, which I thought is great. Every time you go to Japan, you talk around, everybody says, yeah, it's deflationary, it's zero, it's negative. The beauty is that it is in positive drift now. Inflation, 26 or 27 months above 2%, the national CPI. And because it's going at this rate, it's very hard to say that they are not going to really upgrade. So you can see the shift. The balance rate used to be like negative 0.1%. Now they have this target rate, which is like 0 and 1%. So these are key things to signal that they have to move higher. And why they're in this deliberation mode is because there's a lot of trade-off. GDP doesn't seem to be doing quite well in Q1, and maybe also last year. Inflation is high. Yeah, they should do something. Yen, wow, is continuing to weaken. So there's quite a few moving parts. The BOJ, Ministry of Finance, they need to do something about it. They are definitely watching very hard. Trust me, they are definitely watching every single moment. They need to do something very soon. Invention, rate dynamics adjustment, that has to happen very soon. But I can see that today, yen is really at one of the weakest point in the last, I would say, decade or so. So it's been weak. And maybe last point, if I may, Olivia, just to wrap it up on the outlook, Singapore. One thing great about Singapore is that we are always ahead of curve, which I thought is a good thing. And why I say that is that look at the first tightening of the Singapore MAS policy statement. It's in October 2021. 2021. Imagine the Fed does it in March 22, ECB in July 22. Of course, Singapore as a sovereign, you saw the inflationary pressure coming through from the region. They start to do a so-called tightening bias 5 times out there, and they're definitely in a bit more stable mode. Restrictive policies stay where we are in terms of its slope, width, and center band of the entire currency's policy. And they are trying to provide a lot more information now. One good thing that started this year onward is that now they're having 4 times a year. It used to be only twice a year. And I thought that's great because we have a quicker way of resizing our position, whether it's your institution or retails. They tell you more, they provide more information, you can react faster. Better communication in the market. I thought these are all great things. GDP's data point, they're definitely good. 3.1% for the inflation just a few days ago. Even the all CPI prices, 3.1 is up. So I think we're in an elevation out there. So all in, I would say Singapore is still in a restrictive band in terms of the so-called economies. And therefore, I think the rates will continue to be elevated for deposits, MAS bills, and the likes of it. We'll chat more a bit more. So, Olivia, helicopter view, 5-10 minutes. I hope I wrap it up. I thought it was a good summary.
Absolutely. Thank you for touching all basis points in terms of like the different markets, and also, you brought up the keywords like even Japan and Singapore, and coming back to home, right? Home ground and where we stand in terms of that global perspective that you highlighted. Now, on that global front, now we're going into the emergence of a new season. My next question for you, Darren, is what is then your assessment on the global MMF flows since COVID-19? And are they structural, and where are we headed into the year end? I mean, a lot of our investors right now are checking in mid-year to see how they can re-strategize.
Okay, sure. Yeah, I think I have a slides on that, and then I'll just chat through and then sort of like point to some of the items on the slide. I believe that's probably in slide 14, perhaps. If I may, yeah, thanks for that. So one very interesting thing about the money market funds globally, we're going through a new season, a new paradigm shift since the 2020 so-called COVID dynamics. I'll break it into 3 parts, and kindly allow me to point you to the bottom left-hand side, the screen out here. There's a very interesting chart which I'd like to share. The blue line is basically the money market fund flows globally. The yellow and the pink or the red line, as you can see from the screen, is basically your Singapore interbank rate and also the Federal Reserve Fed fund rates. So looking at this screen in front of you on the bottom left-hand side, there are three boxes on the left, middle, and on the top, on the right-hand side. On the left-hand side, what I'd like to share is that when there is an interest rate cut, where your interbank rate, your Fed fund basically all went all the way down to almost zero, you see on the bottom left-hand side, money market fund flows went up. As you go through the transition in 2021 and 2022, the rate was still very low, at zero, very flat. Money market funds continue to edge even higher. When the rate hike came, in 22, 23, and also into 24, what happened was that the money market funds flows continue to go even higher. I think the sharing on this to everyone and to myself as experience is that since the COVID environment, we are in what I call a dynamics of an all-weather situation. And why I say all-weather is because when rates are getting cut, rates are low, rates are up, rates are plateauing, there are interest in money market funds globally. I think that's a key thing. And we ask ourselves, why that's the case? Because of the emergence of new groups of clients post-COVID. I'm not sure about the crowd out there, and I'm sure we all love the Moomoo apps out here. You can do auto sweeping. You have a digital wallet out there. You disrupt. You don't have to go into some counters to probably put your money out there, physical cash. You just transfer from one bank to another. Everything is more done in a very quick, in your pockets, in your handphone. So I think this disruption is evolving. It's very important. Therefore, these flows continue to be very dynamic on its growth. Regional clients, of course, some feel that Singapore dollar is very strong. Therefore, I can see some of these flows also come to Singapore. So all these flows are also growing out there. And I think one beauty for all of us is point number 2 at the top-hand side is cash indicating a real yield. Let me just share with everyone what we mean by cash indicating a real yield is that if you buy into the Moomoo into the Sing dollar cash fund, it's probably running at a gross about 385, 390 gross. And inflation today registered 3.1%. Inflation 3.1, cash fund yield 3.85. You are getting real return in your product, in your investment by doing nothing. So I think that's an important point to take note. Therefore, people start to feel that, oh, great asset class to own, negative correlation with the market, great savings, place to park your money. And with all this as a background, I think the key thing also to share is that money market funds globally is around 6.1 trillion in assets. And I guess there was a question about where we want the flows to go and where we think is happening up there. Some of the key observations of the market is that in terms of the so-called rates dynamic, currently it's still on an updrift in terms of its so-called fund flows. And for the so-called fund flows to be on the move up, it will continue to happen. And some of the reports out there and some of the empirical studies shows that when the US Federal Reserve does its last interest rate hike, which is probably in July 2023, it will take about 14 months before the so-called fund flows start to plateau or even sort of just stay around there. So what it means is that at the way it goes, holding all things constant based on historical data point, it means that the fund flows will continue to keep creeping up until minimally maybe around September this year. And the fund flow will just continue to stay all the way there. And then, of course, we want to look at both sides of the coin. We're just not here to tell you it only go one direction and it's not going down. I think there are also empirical studies out there to say, oh, when will the fund flows of Saudi money market fund potentially dip? Because we could understand, this is markets as cycle. We can't think there's always one directional. It can be a better paradigm shift, more flows in future, but there could be some asset allocation drift. The drift is that if the Federal Reserve ever starts its first cut, it will usually take about 12 months before the fund flows start to go down. If you think the first cut of Federal Reserve is going to be in December this year, that means your fund flow is going to be starting to dwindle down a little bit, maybe in December 2025. So I hope that gives a bit of thoughts about where we are. But more importantly, to summarize, we are here to also want to solve an industry problem. I can see the keyword out there in the middle. Why I say that is because if you believe you're getting some savings, some rates that is probably at a lower end, this could be a good consideration because it only buys into deposits and it only buys into the bills. And maybe with that, just let me allow maybe 2 minutes. The next slide, please, if I can. So this is just some of the products that we as a team manage, me and the team on the treasury management side. They work really hard on all this fund. Thank you for them. The team who does all these things. And of course, my families, I think they always put a lot of encouragement to tell me I should do all this very well. And why I used the word solving an industry problem just now was that we are elevating a new season. We want to understand the pain point, the challenges, how we can turn around faster, like T0, Olivia, the T0, I think that's working quite well for you to convert
Mhm.
into a US dollar investment. So just on a very high level, if I can point to some stats, and the crowd out there, this is a bit of exam tips. Please look at some of the numbers. I think it'll be useful, trust me. Um, you'll need it somehow later on. In terms of some of the statistics, we do have some key product that we think is not just for commercialization, but it helps solve our personal, our industry challenges. Sing Dollar Cash Fund is T17 cycle. Is today AUM about, in fact, today is 5.15 billion. It's a very decent fund. It runs about 3.85, 3.9% of the gross yield. Liquidity fund T0 in seventh cycle has done about 362 million. Very decent. It's only about 8 months old. It's a partnership collaboration with, of course, moomoosg. We do have a US dollar cash fund also. That's also quite a decent product, but more in the US market. But if I may just share one very important point, which is a red box out there. And this is where what you invest in, what we all look at, comes into a very important business proposition of what is underneath all this product. The key point to share, and let's focus on Sing Dollar liquidity and the Sing Dollar cash fund, which is on the second, or rather, yeah, the second and third column up here. The key sharing and takeaway is that we only invest in investment grade deposits and also bills. MAS bills, the 1 month and 3 month. And I just look at the data point, the team was telling me that while today the MAS bill is running around 393, 395 on a 1 month and a 3 month, which I thought was a very good data point. You and I, we cannot invest into MAS bills. It is only for institution. You go via some of these funds, not just us, I'm sure you can buy from a lot of funds out there. MAS bill is definitely on an elevated level. It does serve a very important returns proposition. And I think the beauty on some of these funds, if I may just put it very open to everyone, we want something that is simple, basic. We can all sleep well. We're not saying zero risk, but we're saying the risk is very, very low. And I want to highlight that there's no currency exposure on all these funds. There's no margining, no leverage, no corporate credits. Of course, I do by myself also, so I want to sleep well whenever I can. So those are some key things out there. I thought it's useful to share. Watch out for all those data points. Trust me, it'll be useful to you later on. Olivia, back to you.
Absolutely. Thank you so much for highlighting that. Now, you talked about even the bill situation, right? So I do want to probe a bit further on that. Are the risk-free rates for USD and SGD government bills staying elevated? So what exactly can investors expect during their own asset allocation regarding the space?
Okay. Yeah, I have a slide on that as well, if I may, for the team. In today's context, for the US Treasury and the Sing Dollar bills, thank you. It is definitely very elevated and quite a new era, a new season. And I'll highlight some of these things in a moment. And I think there's this keyword called inversion curve, which I'll also point out in a moment or so. On the left-hand side, this is the dynamics of where we are in the United States kind of a regime. When we say risk-free, that means it's somehow backed by government, strong ratings. That's what it really means on the risk-free, on a broader definition. In US, of course, for the Moody's, it's AAA ratings for the 6 months bill in the US Treasury. It's currently yielding 5.2%, which is quite high. So can you believe it? Oh no, it's a reality. It's not that we believe or we don't believe. You buy a US Treasury, it's at 5.2%. Take no risk, you get 5.2% yield. And why is it so elevated? Is because if you look at the debt situation in May 2023 last year, it contributed to this elevation. It's not exactly coming down yet. And this is an important point because there is some pressure on the debt ceiling, which has been kicking the can down the road. Oh, by the way, I think today is the election. Sorry, today is the chat between Trump and Biden. So keep a lookout. I know Moomoo has one of these broadcasts for tomorrow morning, 9 a.m. So the US definitely will debate about the so-called the US debt. I'm sure that's going to come. But for now, nobody's going to touch it. January 2025, for sure, a consideration. And maybe I would say quite a decent risk that's coming through. With that, US Treasury continue to be elevated, as you can see on the screen out there, or the top right-hand side in terms of the left-hand bucket. And the US 10-year Treasury currently is around today is about 4.28%. So what it means is there's an inversion curve. And let me just put a bit of broad understanding and sharing with everyone. When we use the word inversion curve in the investment world, what we're saying is your shorter end of the curve, like your 1, 3, 6, and 3, 12 months, they are having a higher yield, higher auction data point versus maybe your 10, 20, or 30-year yield. So in this case, your 6 months at 5.2 and your 10 years at 4.22 or 4.28 today. So that's where the inversion comes. And this is a new season because this so-called inversion curve has been happening for, it's not exactly 2 years, it's 23 months. I was looking at it this morning, 23 months. In the last 100 years of history, it's never gone through 2 years. So we are in a very unusual dynamics. And also on the right-hand side, if I can just put it in a very quick way for everyone, which is the Sing dollar rates. The key thing to share is that the risk-free today, 3.65, 6-month deal. I know some of us probably use it for CPF monies to purchase. The key thing is that the policy is still in a very restrictive way, therefore it's very elevated. Again, in the Singapore market, also in inversion curve, you buy the 6-month, 3.65, you buy the 10-year bond, it's probably around, 315, 320 thereabout. So that's an inversion curve. And also on the second part that's being, shared by Olivia, what do we expect as an investor? Ask ourselves this question. If US is at 5.2 and Sing dollars at say 3.65, any investment that you buy into, you must beat this hurdle rate. If you don't get something that's 6, 7%, maybe you don't think you need to really buy anything. Why I say that's because you're getting that rate at risk-free. So anything that is above is a risk premium, and definitely you're taking risk and it must commensurate with a higher return to you. So I hope that's some interesting observation. In short, rates are elevated and we could be very mindful from an investment angle. Even if it's 5% for US that you get today in anything that you buy, it may not be considered that good because the treasury is already at 5.2 fan. I think that's what I'm trying to share. So I thought that's some useful thoughts for everyone. Olivia.
Yes, thank you so much, Darren, for that. Now, as we transition into the last part of our fireside chat, I do want to give the first giveaway out for our quiz one very shortly. So I hope you've been paying attention, everybody. And if you enjoy the content right now, type in yes in the chat box if you're ready.
Yes.
And also subscribe and follow to our channels and also for more content like this. Okay. So it's getting in depth here and we're continuing the momentum with the questions coming in. So thank you so much to everyone for participating. Keep them coming because I'm choosing the best questions to ask towards the end. Okay. Next question for you, Darren, as we wrap up with US rates on hold for longer. What are your thoughts on the risk assets? And are we currently in the bull and bear suit or the bear and bull suit?
Yeah, I know. I recall we spoke about the bull and bear suit and the bear and bull suit. Gosh, it's coming back to haunt me. Next time I should be very careful with my words. I hope I have some good answer for everyone. I think there's a slide on that. I thought about this, and I think we should think through. In the current dynamics on the risk asset, are we in bull, bear, Goldilocks? We'll try to demystify a little bit today. Let's look at left-hand side. In 2022-23, yes, we have a good sense how the market evolves in terms of risk asset. When I say risk asset, I'm referring to S&P 500, the Euro Stocks 50 equities, the Asia Japan equities, and maybe some ETF like the IGs and the high yield. So these are risk asset. Maybe let's just focus year to date, for all this risk asset, they are, I would say, in a bit of polar end. There are some who's like down -2, -3%. There are some who's up 11, 15%. For example, S&P 500, I think is up 15% now, if I can recall correctly. Yeah, it's 15%. So it's at two polar end. And why I share on this is because uh, depending on what products you buy, you can be a bull, you can be bear in terms of the dynamics of where it is. But one key learnings that we have in 2024 and tracing back to 2023 and 22 is that cash is always a very useful diversification. Used as a dry powder, financial distress, market dislocation, draw down some of this T0, T1, buy into a risk asset. If you think it's very topish, very stretched, yes, sell it, put it back into some of this cash liquidity product. It becomes a very good asset allocation strategy. And on the bull and bear markets, which suit we are in, it dawns upon me one very interesting thing, and I just want to talk about the Magnificent Seven. Why I want to say that is because Magnificent Seven, if I can recall correctly, is up about more than 30% this year. Great job for those who bought Nvidia. Pat on the back for you. If you didn't buy, it's okay. I'm sure you have some good opportunity to buy again. Trust me, or the next so-called angel will come to just bring you to that level. I think the key point to share is that are we in a bull and bear or even a Goldilocks environment? For sure, maybe by real elimination, we are not in a bear market for the listed equities. We're in a bit more in the positive, bullish market. So we're like in a bull in a bear suit because there's so many challenges and problems lurking out there, but the market's running so well. All right. So I think we're more like a bull in a bear suit in today's context. But more importantly, back to the Magnificent Seven and NVIDIA. I noticed one thing in case if there's anybody who talks about this and like some of my views about the Magnificent Seven out there. To me, I thought the Magnificent Seven looks a little bit quite exciting in terms of its so-called price action. I don't think we are in a bubble yet. It may be a little bit bubbly, a little bit bubbly. It's not bubble. Why I say that is because if you look at some of the data points from historical set of things and also some assessments on flows in the markets and the way people are trading on their emotion and behavior, the US 10-year today is only at about 4.2, 4.3%. If we are in a dynamics whereby the US 10 years about 5, 6%, yeah, then you know a lot of tech names are going to feel the pressure because they probably borrow lots of money and then the collapse will potentially come. But they're not in the category. Valuation-wise, yes, a little bit stretched, but no, they are not really out of whack. So I think there's something to think through. With the house, we are definitely on the bullish camp in terms of some of these key markets. And also, more importantly, one thing we want to be very mindful is as much as we're in a very bullish dynamics on all these so-called listed markets in US, I think the key point is that it's a very narrow and concentrated run, which we need to be also very careful. And why I say that is because if you look at the Magnificent Seven, they are about 31, 32% of the S&P market capitalization weight. Can you imagine you buy these 7 names, you are going to be like owning 32% of the market cap S&P. Wow, that is really quite a big number. So it's a very concentrated run. Make your own assessments on them. The key thing to share is that definitely there are pockets of opportunity to run further, but it's not exactly a broad-based rally in today's context yet. And maybe just one last part on the right-hand side. I highlighted something on Japan because I was looking at it again. If I look at on the right-hand side, what I'd like to share is that Sing dollar definitely is a very strong currency. In recent years, it should continue to be because you don't really have a runaway inflation problem. You don't have a weak currency out there like some of the regions, as you probably notice. And what I like to say is that it's always a strong source of alpha capture. Imagine you can be buying the Japan equities, convert that into Sing dollar, do some numbers, do some math. Since COVID to now, you notice that your return is not going to be so huge because since COVID to now, which is about 4.5 years, your currency, Sing dollar versus Japanese yen would have lost about 46, 48%. So what I'm trying to say is that you can be very focused on buying your whatever investment TCs and asset classes, Watch out for the currency. That is quite a big move. It's a disconnect because of the interest rate differential. Watch out for that. Sing Yen, have a look. It's definitely losing about 47% in the last 1.5 years. So that really sort of like triggers me. I'm not going back to Japan for about 6 years already. I would like to bring my family there. It's definitely going to be one of the good trade if you ever go to Japan. You're going to have some good Japanese yens to sort of transact and buy. So Oliver, maybe back to you.
For sure, Darren. And we have some people even interested where you're potentially going in Japan for your holiday, but we'll answer that at the end.
Okay.
So thank you for the fireside chat and
Mm,
for really outlining comprehensively the analysis on all these talking points. Thank you for that. We got so many questions coming in for you. So I'm just going to pick out a few towards the end, okay? But for
mm.
that, get ready for your first quiz question, everybody. And Darren, just stay on because I'm going to get you to answer the right answer for everyone, okay? So for those of you who didn't join us before, here is how the quiz works, okay? So the first 5 users who answer the questions correctly will be awarded with these points. It's quite a lot of points, so definitely fastest fingers first and make sure that you get it right. All right, you cannot have the fastest fingers first but get it wrong. So definitely put it in the chat box in app for our users, and these are the mechanics on how you can redeem it after, okay? So are you ready for quiz 1? Type in yes right now in the chat box. Yes, perfect. We have everyone ready. Your first quiz question in 3, 2, 1. What is the indicative AUM of Fullerton SGD Liquidity Cash Fund of 31st May 2024? Okay, so this is as of 31st May 2024. I hope you've been paying attention to this. Is it A, B, C, or D? Let's go. Okay, we have a mix of answers, Darren.
I thought I gave the tips just now.
Yeah, we did give the hint. Okay, so the correct answer is, Darren?
It's D, 362 million.
Congratulations to the first 5 users who answered that correctly. Yes, follow the mechanics and also how you redeem that afterwards, okay? Stay tuned because we have more coming. Okay, Darren, we'll be back with you shortly for the key questions. Now, everyone follow through with me very, very quickly on how you can access the funds and also apply what you learned today, okay? So if you have your app with you, open your page right now and follow through with me. Okay, so if you go to your tab here, you go to Discover, go to Wealth. Very simple. So I know some people said that they can't really see the tab and all of this. I think it's best to check if you are updated within the app and make sure that it's the latest version of the software, okay? So go to Wealth, Cash Plus, and right here, you can see the first one, Fullerton SGD Liquidity Fund. It's very simple, guys. So you can see over here on the performance, the yield, you can just track it for yourselves, right? You can adjust the time frame as well, depending on what you're looking at, and also the position details as you scroll down. Now, I know I have a lot of questions on the returns and also just a summary of that. I know that Darren also shared previously some pointers as well, and he will share further if you need to. But I think if you want to watch the replay of that, you can do so in the app or after this show ends, okay? You can see the comments related to this, news, anything related to this. So this entire function is an ecosystem within itself to make sure that you have all the indicators at the palm of your hand, okay? So over here, you got the portfolio, you have the AUM. Of course, we covered it just now, and some of you got the right answer and some didn't, but it's okay. We're all learning here. And then we go to summary for the overview. So you can see over here, his name is right here. And of course, the relevant people related to this fund. And if you want the specific fund documents, it's updated within this section at the end, and you can track it for yourself. So if you want to add this to your watch list, top right hand corner, you've got the heart. You can add it to your watch list right here. And if you're done and ready, you can go to subscribe, okay? So for those of you who didn't do the assessment yet, you have to do it before you subscribe, but that will take you to the page of how you can officially put in the amount for yourselves, which is minimum 0.01 SGD, and then subscribe once you're ready, okay? So that is all for the quick demo. Any questions, please put it down in the chat box and the teams will monitor and get back to you. Okay, let's welcome Darren back. And also for quiz 2. Are you ready for quiz 2? It's definitely a surprise, Darren, for everyone tuning in. So if you're ready for quiz 2, type in yes so that I know you're ready.
Yes.
Okay. Quiz 2 question in 3, 2, 1. What is the indicative AUM of Fullerton SGD Cash Fund as of 31st May 2024? A, B, C, or D? Okay, again, Darren, we're getting a range of answers.
Okay. Wow.
Okay, many different answers coming in. Well, I hope some were really paying attention here. Is it A, B, C, or D? Wow. 5 more seconds. Okay, what is the correct answer, Darren?
It's B at 4.9 billion.
Yes. So for those of you who got it, congratulations for that. Okay, let's go into our first question I picked up from the audience, and that was from the beginning when we first started the live. Now, someone has wrote in and said, hi, Darren, a Fullerton SGD fund is one of my favorite funds to park idle cash. But, you
you.
know, with the current interest rates environment and many banks starting to cut it, I would like to know, you know, whether Fullerton is looking at other safe assets to try and mitigate this part, and what can they expect and how it will affect the performance of the fund.
Thanks for the question. In today's context, if you look at the Fullerton, liquidity and the cash fund, we're trying to pitch in the sense that that is really at the safest of the bucket out there in a money market version. And why I say that's because, back to my initial sharing, we just don't invest in corporate credits. We just don't want to really sort of buy into, any FX exposure, margins, leverage. So we're really at the very extreme safe end. We just want to really buy into bills, short-dated bills in this case. Do not expect us to buy into bonds or even government bond because they will create a lot of convexity and duration kind of conversation, which is definitely not in our strategy. And also, when we look at the deposits, we also size it very well. And what I mean by this is that we also ensure that it does satisfy some of the so-called guidelines on the Code on CIS, collective investment schemes, and they have to be a lot better than where the ratings are. So these ratings are definitely in investment grade, and I hope that really gives a lot more assurance to everyone. Resize accordingly for any potential market events and interest rate movements. But all in, we just want to keep it as safe and as basic. So we wouldn't really inject any other thing, which we thought is going to create a different disjoint to what we pitch and what we want to say on that portfolios. Yeah, hope that shares some thoughts.
Thank you, Darren. Next question is related to MAS, right? So they want to know what is the outlook regarding this and them cutting the interest rates, and also what can they expect, because you brought up Singapore and the potential opportunities within space. But if you were to summarize for this user right here, what can they expect, I think, in the next 6 months or so as we transition?
Thanks for the question. In terms of the MAS policy statement, it's now into quarterly basis. So the next one should be in end July. I think that's where the next conversation will come. In today's context, what the MAS and what the entire sovereign is trying to look at is a very much focus on where the data points of the economy is. By that, I mean, for example, your CPIs, your retail numbers, maybe your Nordex, which are important points. I think these data points, I would call it stable, if not with a bit of positive drift already. And the GDP continue to be surprising on the upside. So domestically, all these data points are highlighting the fact that we will continue to be a bit on a tightening bias restrictive stance. I think that's the first sharing, if I may, in terms of the policy statement. And policy statement, by the way, it talks about FX policy, so we don't really have an interest rate policy within Singapore. With just a backdrop, let's also look at the MAS bills and the so-called Singapore interbank rate. It continues to be very elevated because I think the demand has been always there. Therefore, you feel that the yield is always elevated. More importantly, nobody sees this as sort of dipping as yet. All this are said, two things we will have to be very careful or mindful, I should put it. I would use the word careful, mindful. Number one, how the region is evolving. The region seems to give the impression that we have a bit more elevation on the rate rather than the cut. Why I say that? You look at Taiwan, interest rate hike. You look at Japan, hike. Indonesia, hike. Australia, surprise price, it just locked a 4% CPI. It's not going to cut. It's definitely going to be elevated, if not higher. The region is telling us that we are in an elevation. That's a very important point. And the last point, take a bit further out, US markets is kicking the can down the road. Maybe one cut, two cut. If there's event risk, of course, it'll be a different conversation. But to sum up, there'll be a cut. And when there is a cut, it will also have a symmetrical effect to the Singapore economy and the data point. So I hope that shares a high-level view that it's still an elevation, but mindful of the region and the US ecosystem.
Absolutely. And that actually leads us to our next question from an active user right here. So you talked about US, but what are the specific views on the US high debt ceiling and impact, I would say, for them? I mean, you've put it back to home ground in Singapore, but I think for them moving forward, they just want to know for the US and central banks, how they're reacting differently, particularly, and they've highlighted this, towards the like gold, for example, as an investment.
Okay. I'll tackle the US and then the gold in a moment. US economic data for sure is looking quite healthy. Non-farm payroll, north of 200,000 every time, is really very buoyant. Service PMI definitely is way above 50, very positive. Manufacturing is a little bit on the weaker side. Inflation moderating. All in, the US definitely don't think it's going to come down so fast. A lot of people who think there's going to be a massive recession, quite a lot of them are sort of getting out of that, don't really think so. So broadly, the US economy continue to be healthy, buoyant, positive sentiments, and of course with the AI dynamic run. That's one part. Having said, let's look at what the debate is going to be tomorrow morning, 9 a.m. Singapore time. You're going to see Trump and then, of course, Biden doing their chat. They're going to talk a lot about it, throw a lot of freebies out there, which they should. I think both are very important key figures to run it. With that, either or of the administration who wins, we have a decent US debt crisis potentially in, whether is it next year or further down the road. Sorry, let me just retract the statement. I wouldn't say crisis, but it's definitely something that the debt situation is something that cannot continue to sustain in this way. Something has to be addressed. With that as a backdrop, that puts pressure for people to buy gold, which is what I call fiscal gold, fiscal precious metal. I hope nobody asks me crypto. I'm no expert, but we can chat if we need to. That is fiscal gold. And because of that, liquid gold, which is crypto, is also on the move up. Probably liquid crypto is probably up 40-50%, I'm guessing. It has some bearings of run together because they are both negative carry. They both have negative correlationship. So you can see the drift is that people are trying to buy into all these alternatives, into gold and the likes of it, to really defend their positionings and their strategy away from a potential debt situation in US. So I think for that reason, gold is definitely an allocation that we should all have, or precious metal, or commodities. I think these are things that will probably give you a bit of a negative correlationship and so-called protections around it. So I hope that shares some thoughts on that.
Thank you, Darren, for that. Next question. So, they've got a lot of US questions here. Okay. So let's just finish the US topic first before we go into the last two. So we're talking about the big tech right now with the rally, right, of the tech stocks and performance. Nvidia is one of the big names. So if they're riding on this for performance, what are the insights or risks associated to maybe a potential crash once the euphoria is deflated? What is the outlook or how's perspective, Darren, from Fullerton's viewpoint?
I guess in market cycles, there's always boom and bust. It always happens when it sort of like, catches everyone off guard. In the current dynamics, maybe I should say where's the buoyant portion and what we should be mindful in terms of some of this listed space. Well, whether it's Nvidia, whether it's the Magnificent Seven, definitely they're having a very decent run. And it's a paradigm shift. It's about productivity gains. So there's no reason why they shouldn't be in an elevated level. And I think there's a lot more so-called positive sentiments to come. That's on some of these themes, but I think it will come to a stage whereby if the valuation gets really very stretched, or if, for example, there's a bit more of this tit for tat between US, China, some of these controls on some of these guidelines on some of the policies on chips, for example, they know that they can create a different dimensions or mechanics around it, or maybe a disruption, another word is coming through. All this will be really blind spot, and then the whole sentiments will basically change. Or maybe even the US 10-year, if it goes to, I don't know, 5.5%, 6%, it's really going to be a very different discussion, and that will alter the dynamics. And then that's where the winding down or the dwindling part will probably come from here. So I hope that gives a bit of thoughts of where things would be.
Mhm. Thank you for that.
Yeah.
And so, with all these factors that we are considering, what other risks or potential, I guess, indicators they might want to look out for that could boost or affect, I guess, negatively the performance of the Fullerton Cash Fund? And what are some of the ways they can manage that kind of risk, right? Because we're not
Mm,
talking about, just completely abandoning our current
mm,
strategy. It's about trying to
mm,
find ways to make it stronger. What are your
mm.
thoughts on this?
Yeah, I guess when we look at the Fullerton cash fund liquidity funds out here, it's definitely something that's useful, um, regardless of where the interest rate is going to be. Let's take a extreme perspective. If rate starts to cut, what you probably would envisage is the cash fund yield still a decent yield to hold? I hope the answer is yes, to most people, and hopefully to me. I definitely want to work hard for all these things. And if you look around, the bank's rates, the savings rate, the deposit rate, the FDs will also go down. So what I'm trying to say is that when the interest rate turns, you will see a bit of reallocation, a bit of rejigging. I think that's understandable. That's definitely a reality. So what I'm trying to say is that when we look at some of this turning point, it's good that we resize ourselves and look at how much should be in the cash funds, in our cash pot, vis-a-vis some of this risk asset. But one key thing we should also be very careful is that if there's going to be a massive cut in, like, back to my earlier point, it's quite unthinkable. But if it's a 50, 75 basis point cut in the next, I don't know, 6, 12 months, that's not part of a narrative, but I'm just giving an extreme case example. If that happens, I think the risk asset may just go down even faster, because that is a panic conversation that people may just come through. So I hope people can see how you can rebalance and rejig with some of this triple Vs, which I mentioned, validate the time, validate what the value is, and also look at the velocity of the change. I think this is an important point.
Mhm. Very clear, and thank you for outlining that, especially towards
Mm,
the end. Now, if you missed some key points for the live Q&A, I see a lot of new users coming into the live. It's okay. You're coming in midway. It's fine. You can watch the replay, okay, right after this. And
mm,
also, don't worry, we still have one more quiz giveaway, so stay till the end. Now, I'm just going to wrap up with two final chosen questions here. Let's go to Japan, Darren, your favorite. First question is, of course, people want to know where do you potentially feel like going for Japan's holiday?
uh, if my family is on the call, I told them we're going to Tokyo and then probably take a train ride north.
Really?
Yeah, to in fact, there's a place I wanted to go and explore, Karizawa. It's a very peaceful place. It's about 1.5 hour, 2 hour train ride, on Zen. Yeah.
Very,
So,
very zen. Love that very much. So with that topic, right, someone would like to know, and we're getting a lot of Japan questions, but I've chosen this one in
mm,
particular. Japan is currently, the few major economies, still at that amount of rates that we discussed previously. Now, do you see them potentially in terms of outlook raising the rates soon to stimulate the economy? And perhaps what are the indicators stopping them from hiking rates, given that the currently the yen, of course, is weak at the moment?
Okay. Yeah, I answer that in three parts. Japan, just on a very high level, for sure is on a positive drift in terms of its rate move. Why I say that's because if you look at the 10-year JGB, if you asked me 3 months ago, it's probably around 0.6%. Today it's probably around 1%. I think that's a very huge move out there. And why I say that's because the inflation, the national CPI year on year is above 2% for 26 or 27 months already. So that is definitely very elevated. And the union, the ministry, even the prime minister all said that the wages has to go up. So the union, in fact, got very good deal in the last 2 to 3 months. Some of the key unions out there, two of them, Rango and someone I can't remember. So sorry about that. They have asked for a wage rate that's around 5 to 6% year-on-year increase, which is a great thing because if not, the wage is around 2 to 3%. So price actions, wage, all these are on the elevation. So that's for sure a very positive thing. And when you look at whole Japan markets, let's look at where things are. If the rates are going up, there are quite a few good things. And if the currency is at the current so-called weakening bias, maybe I'll touch on the currency first. A weaker currency that's good for some exporters out there, for sure. So that is a positive move for them. If you look at higher rates, that's great for the banking system. Japan also have quite a few decent tech companies. So all these are also bringing the so-called Nikkei 225 or the so-called MSCI Japan to elevated level. So all in, I think the market continue to be also very strong. And what could really be stopping the market from going forward? So the anticipation, in my view, is that the rate move upwards probably should come in July, if not Q3 for sure. I think they're just holding back too much on that already. What's going to be on the opposite side of it? The GDP is definitely in a bit of concern, negative 1.8, if I can recall, or Q1 is below expectation. Q4 was also not so great. The yen, definitely they need to do something about it. It's getting very weak. The Ministry of Japan has to really come into intervene very soon in that angle. And also the fact that if you look at Japan, it does also create a new paradigm of where they want to grow their business because they are away from zero rate in zero growth. They definitely want to move to the next excellence of success. So all in, I would say that Japan is a great market to be in. There's some of this pitfall which I mentioned, but definitely the rate hike will come quite soon in Q3 for sure, or July maybe.
Absolutely. Thank you
Yeah.
so much, Darren, for that. Now, before I go into the final question and giveaway point and also the final takeaways, I do want to reward everyone for being here with us with the final quiz giveaway, okay? So if you're ready, give me your favorite Moomoo emoticon in the chat box at the moment if you're ready for the final quiz. Okay, looks like we're having a lot of energy in the chat box. Great stuff. Okay, in 3, 2, 1, here is question 3. Fullerton SGD cash fund settles in X business days or day, and Fullerton SGD liquidity fund settles in X business day or days. A, B, or C? Is it A, B, or C? Darren, looks like people are just giving a mix of answers today.
It's okay. The new season.
Yes, the new season. We're getting all kinds of answers in the chat box. So I'm gonna give you 5 more seconds. Someone just sent a crying emoticon.
No, don't.
Oh
We will
no.
make it together. No, don't.
5 more seconds, everybody, and we'll reveal the answer. Okay. And Darren, what is the correct answer? A, B, or C?
A, T1 and then T0.
Yeah, so those who got it right, congratulations. And remember to follow the procedure after the show and of course, pay attention to the mechanisms that we shared before, okay? Don't worry, this is not your final chance. We'll have the next show that's happening very shortly, and you'll have more chances to win some quiz giveaways, okay? Congratulations to everyone. Now, Darren, as we wrap up, my final question for you is, in the past, you love to share about food
Oh,
prices, right? We love your sharings. I mean, other than the bear and bull suit and the bull and bear suit analogies, you've also brought up analogies like karopo, chicken, soybean, and also rice, right? So I think
mm.
for today, what then is your highlight for the audience members and your final points?
I really look like a foodie person, right?
All of us.
All of us, okay. No, no, thanks for sharing on that. And I thought the sharing in this particular, preso is that let's have a look at cocoa prices. Cocoa prices up about 100% year to date. If you asked me 3 months ago, it's probably up about 170%. It's really quite high. What does it mean? It's going to impact your beverages like your chocolate drinks, your chocolate bars, your chocolate cakes. I think there's something that we need to be really very mindful about. Why that's happening? I guess the key point to share is that Ghana and Ivory Coast, they are okay in West Africa. They are two of them combined. They're about more than 50% of the so-called supply of cocoa to the whole world. They are definitely facing some challenges out there. And what I mean by challenges is that I would say that they are feeling the pressure of the so-called torrential rain and the drought. B, I would say that sort of stems of some of these trees are feeling some problems. Like for example, they call it, sorry, I'm not expert, but they call it black pot. They call it like swollen shoots. That's really impacting the growth. And a lot of trees of these these cocoa trees, they take about 5 years to grow into a fruiting tree. So what it means that you can plant today, you can get your first cocoa seed like 5 years later. And of course, there are also some restriction and bans coming through in some of these countries. So these are putting pressure out there for the cocoa prices to go higher. In fact, Oliver, I should have a question for you. I mean, have you gone to Kopitiam or any of the coffee shop lately to buy
Yeah,
any
I mean,
drinks?
yeah, of course. I love my kopi.
Okay, okay, kopi. I do buy my kopi too. Have you drink Milo Dinosaur before?
Yes, of course, but it's always
Okay,
hard to get all the bits on the top,
and
right?
don't get choked with the powder, the
Exactly.
yeah, yeah. I always drink it very
It's a childhood
carefully.
favorite for sure,
Yeah,
for sure.
yeah. So I noticed Milo Dinosaur. If you ever go and drink, guys, everyone out there, the price is definitely going to go up. The chocolate
Mhm.
prices, Milo prices, I mean, orders are going up. Yeah, I mean, unfortunately, this is just one of the demand supply forces that we go through. Keep a lookout. That is definitely going up. Even for coffee prices, though. So in coffee, I take my coffee shu dai,
Okay,
Um,
mine's kopi C.
Oh, kopi seed, okay. Cheers. Coffee seed is about 20%, 15 to 20% this year, so that will have a bit of elevation.
Mm,
And I guess why we say all these things about all these different food prices because it's about awareness. We're here to
right.
learn, exchange thoughts, be mindful of the surrounding, and we can appreciate finance 101 and our finance, and economy a lot better. I thought that's what's the beauty about sharing some of these food prices with everyone.
Mhm.
Over to you, Olivia.
Really relatable. And thank you so much, Darren, for ending on that note because it really puts into picture and perspective for our active investors tuning in. We still have questions for you, but that's all the time we have left. And we really thank you for that last point. So remember that analogy and also that food symbol. And yeah, stay tuned for next time on what the next food item or metaphor will be. That was Head of Treasury Management, Darren Tay, everyone. And yes, we look
Thank you.
forward, Darren, to the
Thank
next
you.
show with you anytime soon.
Thank you. Thanks for that. And thanks, Olivia. And no, the crowd's great. Feel free to feel engaged, do what we can, and I'm sure we'll all do well together every time in terms of investment.
Yes, thank you, Darren, and we'll see you at MooFest.
Yeah, see you.
To everyone tuning in, thank you for your great energy. If you want to watch a replay of this, you can do so in app. You can follow my page right here on the left. We've got the QR code on the left and on the right. Yeah, we just pull up the slides for the social media pages as well. So if you can see right here, we've got the 2 QR codes. It should transition into that soon. So on the left, you got the pages. Even if you're in app right now, you can scan it and follow my personal page, because I do post regularly and interact with the community on their thoughts and insights and also what they want to see next. And of course, we've got the social media pages, our YouTube Singapore channel on the right here, where you can also join the Telegram community, Facebook, Instagram, Twitter. We're on everything, but definitely follow us because they're all tailored content on what you want to view. Okay. The next is really about Moo Rich account. So where you're watching this on, definitely follow through with this, because this is where you can catch the replays and also any updates on MooFest and anything related to funds and news analysis, all the summary points and community forums right here. So follow them as well. Okay. And next up, very, very exciting, everybody, is happening very soon. Yes, it's the next show of today and also the final one for today. We've got a round of shows tomorrow as well, but I will share that later on. Do tune in right after this if you missed any quiz giveaways for this next show, where we'll just focus on the US itself, okay? And next up, of course, as promised, MooFest 2024. I mentioned this with Darren before, but we hope to see you there. It's a way to reward you for being here with us, but at the same time to educate our users and make sure that you really feel being on that journey with us for your own personal finances. Okay, so hope to see you there. Make sure you say hi in person, and it's going to be a grand affair. So really looking forward to it, everybody. Thank you once again for being with us for the emergence of a new season in the current interest rate cycle show with Fullerton Fund Management. We'll see you for the next show very, very shortly, okay? So please join us for the final show of the day, and we'll see you very soon. Once again, I'm Olivia Higgins. Okay, cut. Thank you,
Good.
Darren. We
Yeah,
did not have
good.
time to do all the questions, but of
No, all
course, we
good.
ended with the Milo dinosaur topic.
Yeah, it injects a lot of content and another fun like moment. I thought that's something maybe is quite all right. I hope you find it okay. I mean, you guys, yeah.
Yes,
Mm,
for sure. And we'll
yeah.
track the movements. We had so many questions for you, Darren, but we could not answer everything. I
Yeah.
did prioritize
No, thanks for that.
according to that. So yeah, I mean, they love Japan too. So transparent. Yeah, and they started asking like, where do you want to go for your next holiday?
Okay.
So that's
Yeah.
why I thought to throw that to you,